We have got a panel on igniting investment. I'm just stood here holding 4 microphones, feeling very uncomfortable about it. So please welcome Michelle Law, Zoe Rees-Oliver, Ben Cooper, and your panelist host, Nina Hampson, who are going to talk to you about VC, angel investment, and also crowdfunding. Please give them a warm welcome.
Hi guys, so we're here today to talk about raising money, not grants or from anything else. So my own history, I've built and sold 2 companies. The first one I used VC money, the second one was self-funded. And recently just done a study with Imperial College to say that found that 65% of founders found their biggest barrier to success was actually successfully raising money and successfully getting investment strategically. So today we're going to talk about the different methods, the different stages of investment, and then why that's important with the different types of people that you approach. So, but first off, we're going to start with Zoe, who's going to talk to you a bit more about crowdfunding, which was talked a little bit before for Brewdog. So we're going to get a bit more enlightenment now from that.
Thanks, Nina. So it's been really, really inspiring listening to all the speakers today, and so many people have mentioned how important it is to kind of wear their heart on their sleeve as a founder, show their personality, build in the open, all of these incredible things that are going to help startups to connect with their potential customer base, their potential users, and crowdfunding can be a really, really exciting tool in order to actually enable startups to do just that. Brewdog was mentioned earlier, which is incredible, the amount that they managed to crowdfund. I actually work at Crowdfunder UK, which is just up the road. We've got a new key headquarters, so it's really exciting to be in this room today with all of you, talking about investment in Cornwall, tech industry in Cornwall. The one thing that I would highlight about Crowdfunder UK is we're a non-equity crowdfunding platform. So rather than supporters coming along and maybe having shares in return for a financial contribution, we actually encourage project owners to offer rewards by way of a thank you. So that could be something like a pre-sale for a product or a discount on signing up for a subscription or something in the future. What this can then do is create a really lovely customer base and a network of support for when your product does come to fruition. It's a really low-risk way of testing the water to see if there is a market out there for your idea and for your product or your service. And ultimately, done well, it can then go on to unlock additional funding in the future. Think of it as a potential marketing tool going forward. You're going to put your ideas out there. You're going to build in the open, which I really, really love that phrase. You're going to tell everybody what you're doing, connect with those around you, get them on board to actually support and become part of the journey with you, and then continue to keep them in the loop throughout the course of production, potentially bringing something to market. They will then back you and become advocates for what you're doing. So there's lots of wonderful benefits that can come along with using a platform like a crowdfunding platform to actually make sure that you are creating advocates and awareness around what you're doing, and ultimately get your idea funded by those that are going to benefit from what you're doing. So it could potentially be a really exciting way in order to take that first step into raising the money that you need.
Perfect. So that's a really good start. So now we're going to talk a bit more about VC and angel-backed equity, which always seems a bit more scary. And we have with us Michelle, who is a VC, and we have Ben, who's also angel in an angel network. We're going to talk a tiny bit about a family office too. But first of all, we're going to start off and explain the different stages. So you might have heard them talk about it today: pre-seed, seed, Series A. You have to understand where you are, and I have to understand what these really mean, so that you actually target the right people and speak to the right people. So Michelle's going to talk to us a bit about that.
Thanks, Nina. Can everyone hear me? Yeah. So I think it was quite interesting to hear Anna in the talk in the panel just now saying, somebody came in and said, "I've got an idea. Can I have £1 million?" So the reason we're all giving that a wry smile is because there are stages. It's a building process with startup funding. So that's what we mean when we talk about pre-seed to seed to Series A and beyond, is that those are essentially stages of development of your company that go from needing a small amount of money, i.e. at pre-seed or even before pre-seed, there can be grant funding available or other sources, to turn the idea away from something that's just simply on paper, but to turn that into something real in some way. And all startup businesses are different, so what that actually looks like, there are no hard and fast rules. So they're really just kind of guideposts really around, beginning to develop a product, potentially taking on some other team members to just start kind of turning the idea into the beginnings of something that could be a successful commercial venture. You then move from pre-seed up to seed. Now, you'll hear, talking about these different checkpoints, people talking about the concept of runway. So the idea is that you should go and ask for your pre-seed funding, you should raise that funding, and there should be a plan for how that money is going to be used. So it's going to get you from, ideally, pre-seed up to a seed round when you have done some initial market testing, done some validation of the product, helped to sort of try to firm up a bit what it is that you're doing, maybe test a few things out, with an idea that you're going to complete that process within a certain time frame. And then the idea is that you would then, having ticked all of those boxes, be able to go back and say, this is what we've learned, this is what we're going to do next, and this is what we're going to need in terms of seed funding to take us to that next level. And so it goes on. So as you move through the checkpoints, the funding requirements typically increase. And so then, as Nina said, you really need to understand where you are so that the amount that you're asking for feels appropriate, that you're going to speak to the right investors. Some investors don't invest in pre-seed or seed. Some investors want companies that are already revenue generating. So it's really important that you know where you are in terms of both expectations of your typical startup journey, but also so that you're not wasting your time going after the wrong sorts of investors who are not going to be a good fit for you.
Yes, so just to clarify, so pre-seed is when you've got an MVP or minimal viable product or a prototype, and then once you've gotten some traction, then you're looking at a seed round. Then it's very, very specific in VC language, and when you're actually looking to raise, this is what you need to work out where you are on that journey. So the next thing we're going to talk to you a little bit about is what is the difference between an angel syndicate, the difference between a VC and a family office, and kind of what you get from them, because they all bring different values to your business. And we're going to start there with Ben, who's going to talk to you a little bit about that.
Sure, thank you very much. So those of you who don't know me, my name's Ben Cooper. I'm an angel investor. It's one of my hats. I'm also a director of Tech Southwest, and I'm focused there on the sort of funding and finance aspects of raising money, I suppose, for tech companies in the Southwest. So what's the difference? So what is an angel investor? An angel investor looks like me or looks like any other individual who wants to invest in early stage companies. As Michelle was saying, I get involved in companies in sort of the pre-seed area, so early MVP or idea stage, and I can invest individually as an angel investor, or as Nina was saying, I could get involved in what's called an angel syndicate. So I run an angel group called Angel Investors Bristol, and that's got about 60 members, so 60 people like me, I guess, who are looking to invest in early stage companies, and we will group together and see different companies pitch to us, as we had this morning. Lots of different companies pitching, looking for investment. And if there's enough interest within the group, we may group together and invest in that company as a group, I suppose. Then beyond that, you're starting to look at sort of VC, which is more into sort of Michelle's world, around funds, early stage funds, SEIS, EIS funds. We can talk a little bit about SEIS in a minute. And then into Michelle's world, which is more around sort of VC funds, and then into private equity. And then I think you mentioned family offices as well. So family offices are interesting because they tend to be, well, they are what they are. They tend to be high net worth families. It's family wealth. They tend to operate a bit like angels in a way. So their investment process tends to be a little less formal, a bit more angel-like. but they tend to have more significant funds available. And again, often they can group together. Family offices can often have a syndicate in a way where they group together not just as the family individuals within that family offices, but different family offices that they may well know will group together and invest in those firms.
I would say the other thing that family offices tend to be is patient capital. So you hear this bandied around. So VCs will tend to look for, a return 5-7 years probably, whereas angels and family offices tend to be more patient. So they will back you. It's always good to look at a family office. You may not even have heard of them. They are sometimes difficult to find, but in a downturn, they will still have money because, of course, they're super rich. And they're like very, very rich angels. And so they will be there behind you and they will always support you. They really, really buy into the founder team and they will back the people as well as the idea. So it's definitely worth thinking about when you're looking for investment. Some of them do pre-seed, a lot of them are a bit later. We're going to dive into the world a bit more of the fun world of VC now, and just to explain a bit more about what they do, and maybe a bit about what they look for, because not all VCs will be sector agnostic. Some are very focused on specific things. This is something you also really need, as well as the stage, is something you also need to look out for when you're approaching a VC.
Yeah, so with Quantex, Quantex is a Southwest-focused VC fund investing in global high-impact ideas in healthcare and sustainability. So you'd be surprised, given that that is publicly available information on our website, how many random inbound inquiries I get from, software developers in the US, or, asking if I will look at their pitch. So do not do that. In fact, every VC, will have a website and will say what they're interested in investing in. Sometimes it is geographic, sometimes it's sector-specific, sometimes it's a combination. And then, as we said earlier, there'll be different stages that they're interested in investing as well. So again, raising money is time-consuming, and it really is not worth your time barking up the wrong tree and pursuing VCs who are just not going to be a good fit for you across any metric. In terms of what VCs offer as well, VCs have different models in terms of how they engage with their portfolio companies. So, you get everything from, low volume, high conviction, high touch, which is a bit more like what we do, which basically means, we take an interest in our portfolio companies. We have a board position on every portfolio company. There's a lot of informal mentoring, business support and advice that goes on. So almost like a kind of hands-on private equity type model where they tend to get a lot more involved in the businesses. You then also have the extreme opposite of that, where there are, large European VCs investing, in hundreds of companies across Europe who, may have very little actually to do with them on a kind of operational, regular basis. So, it's important to be clear about what you're actually looking for. Maybe the hands-off approach is perfect for you. You just want the cash and you want to crack on. You think you've got the support that you need. Maybe you do want to have a hands-on investor that you can go to. You can have regular touch points with. Again, that's an important thing for you to consider. This is never just about the money and the check. It's about everything else that wraps around that. So, we see at Quantex that there's definitely a value add there with all of the stuff outside of just simply funding.
Yeah, and remember, you're interviewing them as much as they're interviewing you, because yes, you've got their money, but it's like a marriage. You're getting in bed together. And I can tell you from experience, having had a good and a bad experience with VCs, it's super, super important. We've got quickly just going to talk a little bit about SEIS. We've mentioned it, I've heard it mentioned in a couple of sessions, but just to be all clear, if you are pre-seed, you should be applying for this, and I'll let Ben explain a bit more about it.
Yeah, sure. Thanks, Nina. So SEIS is Seed Enterprise Investment Scheme. It's a tax incentive from the government for investors like me, angel investors, early stage investors. Basically, if you're a startup company and you're raising your first sort of £250,000 or £250,000, you can apply. If you're an innovative business, you can apply for advance assurance from HMRC. They'll basically approve the fact that you are SEIS eligible. Basically, what that means is that investors like myself or companies can raise up to £250,000, and if I'm investing in that company, say £10,000 as part of a syndicate, I can claim half that money back through my income tax return. So I get £5,000 knocked off my income tax bill straight away. And then there's further other reliefs after 3 years. So my gain is no longer it's CGT free, so and it's also IHT free. So if I pass away and it passes into my estate, it doesn't form part of my estate. So these are all really important things for an investor like me, because it de-risks my investment. So if I'm investing in a really early stage company, it's high risk. So the government is incentivizing me to invest my money in there by giving me lots of it back, and also giving me lots of tax benefits for doing so. So it's really important for investors. I would just very quickly say it's probably one of the most attractive investment or tax reliefs in the world for investment. So the government is using that to try and encourage us, or investors like myself, to invest in early stage tech and innovative businesses. So please do take advantage of it. It's essential. If you go to an angel, they will ask you if you have advance assurance for SEIS.
Perfect. Quick pitch for SEIS. And if you're pre-seed, it's really good. There's loads of really, really good VCs out there that actually fund SEIS, and what they will do is then do follow-on. So the issue is you can sometimes get cornered if you take all monies from grants and you actually haven't raised money in a commercial setting. It can kind of hold you back when you try to do your next round. So you really should try and get a bit of SEIS in your basic funding so that you're actually getting the follow-on from the VCs and the VC network further down the line. It just makes your life easier. And the hundreds of times I've seen startups kind of make mistakes in the early days with their investment strategy, it does make a big difference. So there we go. So hopefully that's giving you a tiny overview. We've totally gone over time, but we thought we might. But there we go. But thank you very much.